Hey there, thanks for tuning in. Welcome to Investing in Germany, and today let's continue with our dive into ETF series. So this is the part 4 of the series. The link to the part 1 to part 3 is in the description. I do recommend you watch the other 3 videos. This series should really help you to navigate yourselves through the ETF jungle, which has now become really complex and complicated. So today's focus topic will be on the index. So index is the foundation of any ETFs. So as you know, the ETFs, the exchange traded fund, tracks an index, and you must be indirectly introduced to an index if you watch a television news or read a newspaper or even a radio news. Every country with a stock market exchange will have an index. Index is nothing but a basket of securities or stocks which are grouped together based on some rules. Mostly the rules is the market cap of the companies. For example, the most popular index around the world is the S&P 500 index, which covers the top 500 American companies based on the market cap. We have an index in Germany which is called a DAX, which covers the top 30 companies in Germany, and we have an index in India which is called Nifty 50, which tracks the top 50 Indian companies based on the market cap. So these are all the geographically limited index. In other words, these are the index which are tracking the top companies in a specific country. So you have to also keep in mind that there could be companies headquartered in Germany, for example, but listed in America because of the available liquidity and the demand. So we have to be cognizant of this as well. One of the major feature of an ETF is a diversification beyond geography. Even though there are ETFs which track specific geography, theme, and so on, there are also index which tracks the multiple markets across the world in different continents. So that's really crazy. You can buy an ETF which owns an Indian stock, American stocks, South Korean, Japanese, South Africa, and so on. It makes life for any investor to invest in different markets without going through and paying of placing an order at exchange around the world to get an exposure of certain market. You should also understand that certain exchanges charge you fees, which does not make a small investment profitable. So ETF brings the whole world of investment directly to you. Being a resident of Germany, if I am not limited to a German stock market, I would for sure 100% go for businesses outside of Germany, because there are a lot of opportunities outside of Germany, because the German market are really conservative and there are not much high quality company at fair price. For example, we don't have Aldi, Bosch traded in a stock market, so there is not much quality available in Germany compared to other businesses around the world. If you're looking for diversification and less volatility to a portfolio, then the international diversification is one of the great way to go. In Germany, there are 2 indexes which are really popular in the ETF market or the exchange traded fund market. They are the MSCI and the FTSE. So MSCI is developed by the Americans, the Morgan Stanley Capital International, and FTSE is developed by the English, which is Financial Times Stock Exchange. Both these index providers, they offer the same product with a subtle twist to avoid direct competition. Just like a Burger King and McDonald's, if one comes with a signature burger recipe, the other comes with a similar signature recipe. And if one comes with a milkshake, the other one also comes with a milkshake, and so on. So both are the same, but there are minor differences between the two. Let's cover the top 3 diversification options. The MSCI World and the FTSE Developed tracks the top businesses from the developed market like America, France, Germany, Japan. So let's call them as developed economies, developed markets. Then we have the second one, the MSCI Emerging Market and the FTSE Emerging Market, which tracks the promising developing countries like India, China, Taiwan, South Africa, etc. Then finally, we have this MSCI All Country World Index or the FTSE All World, which is nothing but a mixture of the developed market and the emerging market. Just be cognizant of the fact that even though they say this is the emerging market, they don't take all the emerging market into consideration. And also the name says all country, they don't take all the countries in the entire world and put it in an index. No, that doesn't happen here. So don't let the names mislead you. The developed market index is heavy on United States. The subtle difference here is that the MSCI considers the South Korea as an emerging market, but the FTSE considers South Korea as a developed economy. If you are looking to invest in South Korea to take advantage of Samsung, Kia, LG, Hyundai, and so on, then you should select the index accordingly and appropriately. The weightage is similar but does not make much of a difference if you see that the MSCI index has more than 1,500 businesses or constituents, and the FTSE has more than 2,100 constituents. So FTSE has taken the diversification to a next level. To me, 1,500 or 2,000 does not really matter, as the diversification is already very huge if you are going more than 20 or 30 constituents, and here we are talking about thousands and 2,000 constituents. So this is really crazy diversification for you. Moving to the emerging market, South Korea is in the MSCI but not in FTSE, because FTSE considers South Korea as a developed economy. Unlike the developed market, here the index is not unproportionally heavy on a certain country. So China has the highest weightage even after the recent unfriendly business policies in China. As you might have already known, there is a lot of government influence in Chinese businesses, and the investors are not really thrilled about it. Therefore, the Chinese market is really at its knees now. Again, even in the emerging market, the FTSE has taken the diversification to another level with about 2,000 businesses. That's crazy diversification. If you are really worried about the Chinese economy and one-party policy in China and so on, then you have to make your selection appropriately to see what one which fits you. There are also indexes which covers the entire emerging market without China or without India and so on. So you can check which one really fits you for your future. And finally, we have the all world and all country index. Again, here the index is heavy on United States. It also makes sense because all the big popular great businesses are in USA, like the Amazon, Google, Alphabet, Facebook, and Microsoft and so on. So it really makes sense there. But it gives also a lot of exposure to an American economy, which is currently fighting the inflation head on, unlike the other markets around the world. So given the strength of the US dollars relative to the other currencies, it really makes sense to consider this type of diversification. MSCI World has about 3,000 businesses or constituents, and FTSE has more than 4,000 constituents. So this is absolute madness. Here the index providers are somehow thinking higher the better. I believe the emerging market percentage within the all country is about 10%. So you can indirectly develop an all country index by investing 90% in the developed index and 10% in an emerging economy index. So you have to see what really fits you and what is your focus area and how you want to make a portfolio. Just to give a comparison, of course not a recommendation. So the 70-30 portfolio is something popular within Germany community. So 70-30 means the 70% goes into a developed economy and the 30% of your investment money goes to a developing economy. But I think the developed markets are not really great investment for the next 3 to 5 years based on my research, and therefore I would reduce the exposure to a developed market and increase the exposure to a developing economy. But then increasing your portfolio weightage to a developing economy means there's a high risk. Considering the current status, China is really cheap due to the government interference, but then it has its own risk. That's why it's cheap. One has to really consider the risk and the reward for your investment and how much of a volatility you can take, and you have to take your own decisions. Of course, this is not a recommendation, so you have to do your own research and come to a final conclusion. What is the weightage and what is the index that you are really going to put your money into it for the long-term perspective. Sit tight, enjoy the ride. See you in the next video.